Welcome to Thursday's Commodities Corner. I'm Elaine Stenson. Spot gold slid 1.5% to $1,200, its lowest price since June 28th. I'm joined on the line now by Ross Norman, CEO with Sharps Pixley in London. Ross, as you know, the Fed reduced the pace of its monthly asset purchases to $75 billion from $85 billion yesterday, and gold plunged to nearly 6-month lows today following the Fed's decision. Ross, did you anticipate that this announcement would have such an impact on gold?
Well, I think the market was split 50-50 on whether the Fed would actually taper, and of course they did last night, as you say. It's a relatively modest taper, it has to be said, of just 10 billion. But the move in gold was relatively modest. Gold is off about 1.5% from where it was trading at before the announcement, and I think one can largely attribute that correction lower to a corresponding move higher in the US dollar. Gold actually was a bit of a sideshow yesterday. I think people were expecting the opposite. Expressed simply, gold is running with some very large long positions, or many traders are, and equally there's a corresponding record number of short positions, the highest on record. So to some extent the market was polarized between those who are long and those who are short. And the feeling was going into this meeting that only one of those groups could be right and gold would move dramatically one way or the other. In the event, neither happened. So I think one could almost describe it as something of a damp squib, really. So gold sort of nudged below the $1,200 level earlier this morning, a 6-month low, before correcting a little firmer. So it gives me some optimism, really, that perhaps we're getting close to the lows now. A lot of the bad news for gold may well already be in the price. And so we remain modestly cautious for the year ahead on the price.
Okay, and while US interest rates are frozen near zero, inflation is expected to climb towards 1.5% as the cost of housing increases. What effect will this have on gold prices in 2014?
Yeah, well, inflation is an important factor normally in long-term expectations of the gold price. But I think it's wrong to fixate slightly on US inflation rates and interest rates, because the market has dramatically shifted since 2008 to being a very Eastern-centric market. Back before the economic crisis, India and China, for example, accounted for 46% of demand for gold. Today it's over 80%. So it's inflation in those demand centers in the East that really matter. And quite often we're seeing that attempts to stimulate the economy in the West often stimulate inflation in those emerging nations, because after all, that's where a lot of the stuff is manufactured that we buy. India, for example, is running at 7.5% inflation at the moment. China close to 3.5%. So you know, at the moment, inflation is still very high in those nations, and for that reason, we're seeing phenomenal demand in both India and China. We think that will continue during the course of next year.
So Ross, are you saying that the economy in the US is having less of an effect on the price of gold than the Asian economies?
Unquestionably. I mean, yes, of course, there's a significant number of investors who hold the gold ETF, Paulson being one, for example, and there's unquestionably the COMEX traders have a huge amount of say in the short-term direction of the gold price, particularly so because of the extreme leverage that futures and options entail. But truthfully, the market's gone from a very paper Western-centric one to a very physical Eastern one. And the first part of the shift, the selling by Western investors and the shorting by futures traders and COMEX, is already in the price. Yet the sort of slow glacial buying by buyers in Vietnam, in China, in India and so on is sort of supportive, quietly supportive underneath the market and growing all the time. Even in Europe we're seeing a very good and nascent market in the UK, and Germany of course is a very robust market as well. So the physical market, these slow glacial buyers are very much taking over the market for what was formerly a very much a US-centric leveraged paper market.
Okay, Ross, thanks for that. We have to leave it there for now, and that's all from Commodities Corner this year. But we will, of course, be back with more in January. Until then, bye for now and have a great new year.